On October 19th, 1987, in a single day, investors watched 22.6% of their wealth just vanish. That was Black Monday. It was a brutal, historic crash that wiped out $500 billion in only 6 hours. For decades, it's been the benchmark for financial disaster, a catastrophic event for sure, but one the markets did eventually survive. Remember that number. It's kind of the ghost of crashes past. Now, look at this number, 90%. This isn't from the history books. This is the potential reality for the average investor in the storm that's brewing. This represents a level of wealth destruction that doesn't just set you back a few years. It takes you out of the game for good. The difference between these two numbers? Well, that's the whole story. It's the difference between a really bad day and a financial extinction event. And this isn't just me speculating. The evidence points to a convergence of factors unlike anything we have seen in modern history. The really crucial point is that the systems, the safeguards we think are there to protect us, they're actually positioned to make the collapse happen faster, not prevent it. So, what is this evidence, and how can you possibly prepare for something of this magnitude? Okay, let's dive in. Welcome to Bullion Signal. Our whole mission here is to help you cut through all the noise and get to the clear, data-driven analysis you need. In this explainer, we're not just going to look at headlines. We are going to examine the deep structural cracks in the financial system. If you want to understand these forces before they hit your portfolio, make sure you're subscribed. Now, let's break this down piece by piece. You see, what we're witnessing isn't just one or two risk factors popping up. It's a perfect storm where multiple financial time bombs are all set to go off at the same time. Over the next few minutes, we're going to dissect this storm. We're not going to rely on opinion or fear-mongering. We're just going to methodically lay out the evidence, showing you exactly what Wall Street sees, but really hopes you'll just ignore until it's way too late. The case for this unprecedented crash really rests on four distinct, but, and this is the key, dangerously interconnected pillars. I want you to think of them as the support columns for the entire market structure. The data shows that each one of these pillars is now fractured and failing. We're going to look at each one in detail, starting with the most obvious and maybe the most ignored danger of all. All right, let's jump into our first pillar, valuations. This is basically the relationship between what a stock costs and what the company is actually worth. Now, in a healthy market, those two things stay pretty close. But right now, they're separated by a massive chasm. Why? Well, a decade of near-zero interest rates and central banks printing money pushed everyone into riskier assets, which inflated prices way beyond their real-world earnings. Prices have just become totally unmoored from economic reality. So, take a look at this. This is the Buffett indicator. And frankly, it's screaming a warning. It's a simple tool. It just compares the stock market's total value to the country's economic output. Warren Buffett himself says anything over 120% is a danger sign. Right before the dot-com bubble burst, it hit 149%. Today, it is at 203%. We are not just in the danger zone, we are deep in uncharted territory. Far, far higher than the peak of one of the worst crashes in modern history. Let's be perfectly clear about this. This isn't a red flag. It's a 5-alarm fire. You look at the price-to-earnings ratio, which just measures how much you're willing to pay for $1 of a company's profit, and it's nearly double its historical average. Every single objective, long-term metric is showing us that assets are priced for a perfect future that, let's be honest, just isn't coming. This level of extreme optimism has always, without a single exception, ended in disaster. So what's the takeaway here for you? First, history is practically shouting at us.
Every single time valuations have stretched this far from the average, a major correction of 40, even 60% has followed. It's a historical pattern with near perfect accuracy. And second, you have to remember that "this time is different" are probably the four most expensive words in investing. Assuming these patterns no longer apply is a catastrophic gamble.
And look, this isn't some fringe view. Jeremy Grantham, the legendary investor who successfully called the 2000 and 2008 crashes, he calls this a super bubble. And what makes it so incredibly dangerous is that it's happening across all major asset classes at the same time. This has only happened twice before in history, 1929 and 2000. When there's absolutely nowhere safe to hide, the panic and the wealth destruction that follows are just magnified exponentially. Overvalued assets are one thing. They're dangerous. But overvalued assets that are bought with borrowed money, that is the recipe for an absolute collapse. So let's move to our second pillar, leverage. This is the gasoline that's been poured on the valuation fire. The entire financial system, from individual investors all the way up to the largest corporations, is just saturated with debt. It's like a coiled spring that's going to unleash devastating force when it finally snaps. This number right here, this represents the total amount of money investors have borrowed to buy more stocks. It's called margin debt. And at $774 billion, it is just shy of the all-time record, which was set right before the market dropped 25% back in 2022. This means countless portfolios are balanced on a knife's edge. For these investors, a small dip in the market isn't going to be a small loss. It will be a complete and total wipeout. So the crucial thing to understand here is something called a margin call. When a portfolio that's using borrowed money drops past a certain point, the broker forces the investor to sell their assets immediately to cover the loan. This is not a choice. It's an automatic forced liquidation, and it happens at the absolute worst possible time. This wave of forced selling pushes prices down even further, which triggers more margin calls, creating this domino effect that turns a simple correction into a full-blown crash. What all this means for you is actually simple, but it's critical. Leverage turns what should be a manageable market drop into a personal catastrophe. It completely removes your ability to ride out the storm because the decision to sell is literally taken out of your hands. And this is vital. Many people are taking on this risk through complex funds like ETFs or using options without even realizing their full exposure. A sound strategy absolutely requires understanding this hidden risk. I want you to just pause for a second and ask yourself this question. Be brutally honest. If you woke up tomorrow and your account was cut in half, what is your genuine gut reaction? Are you buying, holding, or selling? Let me know down in the comments. You know, the discussions we're having in our growing Bullion Signal community are invaluable for stress testing these kinds of ideas. And your honest answer is really the first step to building a resilient portfolio. Okay, now let's broaden our view a bit from individual leverage to systemic leverage. Pillar 3 is about the twin debt bombs that are ticking away at the very heart of our economy. That's government debt and corporate debt. The balance sheets of both nations and their biggest companies are stretched to the mathematical breaking point. This isn't some problem for the future. This is a crisis that is coming to a head right now. The U.S. national debt is on a completely unsustainable path. We're adding $1 trillion every 100 days. This creates a death trap for the Federal Reserve. See, to finance this debt, they have to print money, which devalues your savings through inflation. But if they raise interest rates to fight that inflation, it makes the debt payments explode and crashes the market. They are trapped, and both of their choices lead to disaster for investors who aren't prepared. And this shows you the private sector side of the crisis. Corporate America is sitting on a record $13.8 trillion in debt. That's the highest it's ever been as a percentage of GDP. For over a decade, companies just binged on these near zero interest loans. And they used this cheap money not just for innovation and growth, but for trillions in stock buybacks that just artificially inflated their share prices and, of course, executive bonuses. Well, that era of easy money is over. The consequence of all that borrowing is what analysts are calling the Great Refinancing Wall. Trillions of dollars of that corporate debt, borrowed at rates near zero, are all coming due by 2026. Companies now have to refinance that old debt at rates that are 4, 5, or even 6% higher. This represents hundreds of billions in new, unexpected interest expenses that are going to hit their bottom line like a sledgehammer and just vaporize profits. So this directly impacts your investments in 3 ways. First, higher interest costs crush profits, and profits are the very foundation of stock prices. Second, to cover these new costs, companies will be forced into layoffs and they'll have to slash investment in future growth. And third, and this is critical for a lot of investors, they will have to cut dividends. Historically, when a company cuts its dividend, its stock price craters, often falling much, much further than the general market. And nestled inside this corporate debt bomb is a specific, really acute crisis. Commercial real estate, or CRE. About $1.5 trillion in these loans mature by 2026. These loans were made assuming that offices would be 95% full and interest rates would be near zero. Well, today, post-pandemic vacancies are near 50% in many cities and rates are high. The math just doesn't work anymore, and a wave of defaults is now a mathematical certainty. Why does this matter so much? Because regional banks hold the vast majority of these loans. Remember the failures of Silicon Valley Bank and First Republic back in 2023? That crisis was triggered by about $40 billion in unrealized losses. The potential losses from this commercial real estate crisis are estimated to be over $400 billion, more than 10 times that size. It's a threat that is an order of magnitude larger than the one that nearly broke the system last year. Okay, let's just recap what we've established so far. Pillar 1, extreme valuations, completely disconnected from reality. Pillar 2, unprecedented leverage that's going to amplify every single downward move. And Pillar 3, a systemic debt crisis at both the government and corporate levels, with commercial real estate as the likely detonator. We have seen the dry timber of a financial fire just piled high. These 3 pillars make a crash inevitable, but they don't tell us what lights the match. That match is the 4th and final pillar, investor psychology. It's the predictable, irrational behavior that always signals a market top. In part 2 of this analysis, we are going to decode those hidden signals. But more importantly, we will lay out a step-by-step survivor's action plan, a practical framework for you to navigate the storm. Make sure you are subscribed so you don't miss the conclusion. A solid primary keyword plan is your best defense. The clock is ticking.